This lesson is an expansion of the concept of CVD, cumulative volume delta. I will start with a recap. So in the last lesson, I explained what CVD is from a higher level. I will cover some key points before we jump into the rest of this lesson. So we need to remember that delta simply means difference. Buying and selling, we know, is done through market orders. There will be orders on the order books, but the buyer has to come in with a market order and buy it. They have to take that liquidity, and the seller has to come in and sell and take that liquidity. These are the aggressive traders because they take liquidity from the market, and that's why they're called takers. Every trade has to have a maker and a taker. CVD deals with the takers. And the volume delta is the difference in buying and selling aggression in any single trade. So whoever was the taker will reflect on the volume delta for that trade. Now imagine you have someone who wants to sell 1 BTC. You have someone who wants to sell 1 BTC. They're the maker. And someone else goes, okay, I'll buy that from you. That would equal positive 1 BTC on the delta, if we're talking about Bitcoin. Right? So your maker, limit order, Bobo the bear here, wants to sell Bitcoin. So he puts 1 Bitcoin on the order book. He thinks it's going to 0. It's sitting there waiting to be sold. Pepe comes in, of course, as the perma-bully is, and buys that off of Bobo. He comes in and takes it by putting in a market order to buy 1 Bitcoin. That creates 1 positive on the volume delta. Now, imagine somebody wants to buy 1 Bitcoin. So in this sense, Pepe is waiting to buy. He needs 1 more Bitcoin, and he's advertising, saying, will anyone sell it to me? So he's the maker now. So if you imagine someone wanting to buy 1 Bitcoin, then whoever comes in and says, okay, I'll sell that to you, will create a negative 1 BTC on the delta, because the taker, the person who's aggressive, was selling a Bitcoin, making it drop, making the delta go down. So it's a market sell order, which is a negative delta as the Bitcoin changes hands. So that's volume delta. For each individual transaction, you're going to have somebody who was the aggressive buyer or seller and somebody who was the passive person advertising that buy or sell order. That's the volume delta. So our cumulative volume delta deals with, as the name would suggest, the totality of the delta over a fixed period of time. Right? It's an ongoing measure of the difference in buyers and sellers' aggression for a fixed time period. In the example above, we first had a volume delta of positive 1 BTC whenever Pepe bought the coin off of Bobo. Then we had a volume delta of negative 1 BTC whenever Bobo decided to sell a Bitcoin into Pepe. And so our cumulative volume delta for that period, for those 2 trades, would be 0. Plus 1 minus 1 equals 0. Now, let's look at how to actually trade it. So in coinalyze.net, which is where I track this data, you can view CVD in a number of different ways. You can look at either the aggregated, the total of all exchanges, or you can look at individual CVDs. So aggregated is the view that gives you the entire market. So let's say for Bitcoin, you can see what's happening on all the exchanges all together added up into one indicator. So in this example, I have the 3 types you can have, which are the aggregated CVD for spot. So that is all the spot markets. You can see here all the different spot markets that are picked up by Coinalyze. That's the aggregate of the buying and selling aggression in all of those. Then we have the stable coin margin contracts. So these are futures, again, for all available exchanges. And at the bottom, we have a third one, which is, again, futures, but this is coin margined. That's down to the fact that there are 2 different types of perpetual futures. One where your margin is in a stable coin like USDT, the other where your margin is in the actual coin itself like Bitcoin. So we want to remember, as always, the law of harmony and divergence. When price is in harmony with the CVD, we will see continuation. But when we see divergences, we can take higher probability trades. It's important at this point to narrow the time frame you trade on, as its standard is just set to the full chart in view. Let me explain. When you load up, it will automatically show the data for whichever time frame you're on, 1 hour chart here. The automatic metric will be measured as of all the available data. Okay, so it goes right the way back to the start. So that's going to show the CVD from all the way back here, regardless of what's happened in between. That's okay if you want to get a general view, but if you do something like this, and you're zoomed in, you're not accounting for the price in the history, the price in the past. You're just looking at this and you might think, oh yes, the CVD is going down on spot, it's going down on stablecoins, it's going down on coin margin. Okay, but you're not getting a bigger picture view, because if you zoom out to the totality, you would see, well, actually the spot market is up since the start, whereas both futures markets are down since the start. So then you might say, okay, well, if I look at that, I can see that spot is up, futures are down. That's a divergence, because we have price going up. We have CVD going up on spot, but down on futures. You might say there's a divergence that we could trade, because the market's disagreeing with itself. But you also need to understand, and this is why CVD is most useful on shorter time frames, because it's a faster acting metric to track. If you look here and you think that this is really strong for spot, you're discounting the fact that almost all of the run up in spot happened way back here, and since then it's pretty much gone sideways and actually slightly down. So we'll visualize that. Most of the run up in spot was in that small window. Since then, even though it went up a little, but since then, on balance, it's actually down. Right? So, in totality, yes, it's up. But if you look at it on the chart and then chart price along with it, you see here that initially, yes, the price also went up. But since then, the CVD for spot has gone down, as has the price of Bitcoin. So your first simple analysis would have said, oh, look, from start to finish, we have positive CVD on spot. And from start to finish, we have negative CVD on futures. A common rule of thumb is, if spot is positive, futures are negative, it might be setting up for a short squeeze, because if spot are buying and the futures are selling, the futures could be offside if the market can move higher. But of course, this simplistic first analysis we know is wrong, because most of the spot buying was done at the very, very start. And so if we simply just zoom in to here, we would see that actually spot is down as well. So there is no recent divergence that's valid to us. The way you do that to actually zoom it in is you have to change the indicator. So there's a settings cog. On each of them, it will be defaulted to the full view. And you have to change this part. Only last n bars, 0 for all. So when it's set at 0, it shows you all the available data. What you do is you go and get a date range tool. You want to draw from where it matters. You want to take your tool and draw it across. And we see that there's 1314 bars. So what we do, we go in and we fix it to 1314 for spot, to 1314 for both futures markets. And then we're actually starting to analyze specific periods, and we can be much more accurate. So let me delete all the stuff off the screen. And now you can see that we're getting a bit better of a view of the market. So since we reached up here, since that initial burst of buying on the spot markets, we can see that the market is in harmony, because here was the price. We are down since then, and on spot we're down, on futures we're down, on both of them. So the market is in total agreement that we're in a downtrend. When the market is in harmony like this, you expect the trend to continue until something changes. This is a period at which, if you are, let's say you're in a short, you remain in the short until CVD tells you otherwise. That's if CVD is a factor that you use, of course, regularly. You don't take any trades based on this. At least I don't. It's not a trading strategy to trade harmony. The divergence is where you actually can spot some edge. So if in a trade, CVD is telling you, if I'm in a short, it's not giving me any reason to exit yet. That's the takeaway you should have from this. All right? We want to find, though, where can there be some more edge? So you go into lower time frames. It's always important to zoom in. All right, so let's zoom in and look at the recent price action, because that whole view was looking at price over 2-3 months. But as a day or a swing trader or even a position trader looking to alter his trade, we should be zooming in. So, how do you use CVD best on lower time frames? You want to look at it and say, I have a thesis. You start with a thesis and then you test it using CVD. Very simple. Clearly we can see a long wick below and a pump off the bottom here that hasn't retested. So the wick hasn't been retested. Price has remained elevated. Okay. So first thing I want to see is, what are the chances that we go and revisit this wick? That would be my interpretation. Anytime price leaves a gap behind, whether it moves strong in one direction, you always want to look and say, is it possible that we go back down there for another test? So, can CVD help me to prove or disprove this thesis? I'd say, I think price can go here. I think price can go down there. So, is it suitable to take a short? What does CVD tell me? So, we get our date range tool, draw it across from that time, and we'll see 90 bars. In fact, draw it from the one after. The reason you draw it from the one after is you want to think about how have traders acted in the market after this. So after this bullish candle, wait for one more candle, then draw it across. That's important because after the bullish candle went in, you want to know what people have done then. Makes sense? Because bad traders who get offside will have reacted to this candle, and we want to see how did they react. So 89 bars, we change our CVD measure to 89 on all three, and we look for any discrepancies. And what do we see? We see a nice divergence. There we have spot CVD is down. Futures, on the other hand, is up. And it's up on both futures. Meanwhile, the price of BTC, since here, is also up. So price is up, and it's driven by futures. Now we can really clearly see this. Price is up, it's driven by futures, spot are selling. That tells you this is a short squeeze, right? It's definitely not spot pushing the price up. That means it can only be futures pushing the price up. So it can be a combination of bullish buying by futures, people opening new positions and wanting to get long, but also by shorts being forced to close. We just came in from a downtrend and we're now bouncing off that. So it's likely that at least part of them are shorts being forced to close. Because price moved up like this and has not retested this area, it's okay to suggest that the short squeeze was pretty strong and it didn't allow any type of pullback. So where CVD can help you now is not right away. You don't just jump into a short based on this right away. You say, if my other factors, like market structure especially, and price action, if they point towards a declining market, I can then say with confidence, spot we're selling this whole time, price is now declining. That tells me that the buying on futures was in fact likely just a short squeeze, forced contracts closing rather than new bulls entering, and I can take a high confidence short down to wherever my target would be. In this case, the particular target would be down to here. So that's where you combine it. This is why you'll see that CVD alone is not enough. That's where you combine it with your price action principles. So let's imagine this. You just look at this, a basic trend line. Trend line touches, and I want to see a combination of market structure breaking. So a new low. Let's take a new low below the wick. So I want to see a break of structure, or else taking this out, whichever you want to do. It goes lower, okay? It then closes down there. That gives you a confirmation that yes, we are in fact downtrending, because we had a high, we then created a low, we then created a lower high, and we created a lower low. Basic market structure. Lower highs and lower lows is a downtrend. Okay. Then you would say, I'm looking to get short on any consolidation, any bounce, whatever, and I know my target is back down to the untested area. I know that CVD supports me because spot are selling and futures were buying, but they were unable to hold the price up. If futures were buying and unable to hold the price up and spot were selling, that means that when it goes down, some of those futures contracts will have to close, and because futures is the one that has leverage, that's likely to create a cascade on the downside, which will add fuel to your short trade and give you a profitable trade with a high probability. Okay? So that's how you use it. Zoom in, find a specific period you want to analyze, and use that along with your other tools to add confluence to your trade. Very, very important. And so you can do the same for individual exchanges. The same principle applies. This is useful if you want to take a deeper dive on your earlier analysis. So an example being, like we just had, I see that futures are buying while spot is selling in aggregate, and the price is going up. So I want to see which futures exchange is doing the most buying and which spot exchange is doing the most selling. This can give you an idea of who's leading the move, right? The whole point of that, you don't even need to do this necessarily. This is if you want to go deep on CVD and break into each exchange for future reference. So you would say, I want to go on Bybit USDT pair into this area. We know it is 89 bars. So we put in 89. There we can see, and we can see that there was actually heavy selling on the Bybit pair. So that's interesting because we know that futures in total, just make sure this is correct in fact. Maybe it's different. Okay, it's 93 bars on this one. 93 bars. It makes a very minimal difference. We just wanted to be clear. So we know that Bybit have actually been aggressively selling in this period. Okay, that's interesting because we know that futures in total were up, and so that would make you investigate Binance and all the other ones and say, okay, where is this buying pressure coming from? Because clearly it's not on Bybit on this pair. And so you look into each of them. Then you go to the spot exchanges and you compare those. That's if you want to get a view of the market. Why is that important? It can tell you who's leading the move. And so when you're journaling your trades for future reference, you know for sure this upside was not driven by Bybit CVD. However, they could have contributed to it being held up, because if Bybit are selling aggressively but price keeps rising, they're at risk of getting squeezed because price is going up and they keep selling into it. And so what you want to look for is, when does Bybit give up on the selling and flip to buying, which you can see right at the bottom here. They're just starting to turn positive. They're just starting to buy. And what has price done in the corresponding time? Price has actually gone slightly down. So what can we deduce from that? Well, let's say Bybit were wrong on this move because they were selling all the while price was going up. Okay, so they were wrong. They were on the wrong side of the move. Then what happened? They finally flipped and started to go long, but price isn't respecting it. Price is going slightly down while they're starting to buy. So again, you note that down. You already have confluence for a short trade if you break the structure and you get your other setup. But you can note down and say, on this particular trade, Bybit were wrong on the way up, and let's imagine, just hypothetically, that the Bybit CVD keeps going up, but price keeps going down, and eventually you make a short trade, you win that short trade. You could say, for this particular move, Bybit were wrong both ways. They shorted on the way up, and they longed on the way down. That's valuable information to take with you in your journal for future to compare against another situation. Let's say 4 weeks from now, you go back in, you look at a similar type of setup, and you see the same thing, spot selling and futures buying. You zoom in again, and you see that Bybit are doing the same thing again. Then you could say, okay, last time this happened, we had this move. Let's compare and contrast how this time it goes. The point of zooming into specific exchanges is to give you an idea of who's leading the move, who's possibly on the wrong side of the move, and over time, you can spot patterns of behavior across exchanges. The individual exchanges are not supposed to be used to take trades, because if you only looked at Bybit's data, this is actually a really good example. So in this example where it's zoomed in, if you only looked at Bybit's data from the very start, you would think that futures are selling. But when you looked at the aggregate, we actually know that futures on balance were buying. So that's valuable information that you would have missed if you just started with the zoomed in. So always start with your big picture, your aggregates, then zoom in to get specific data, and then you can add context to it, keep it logged. It might not seem like much now, but when you've done 20, 30, 40, 50 of these CVD-based trades, and you understand for each of these periods of 3 or 4 days of price action, who was doing what, you can then have a huge log with a bunch of data that becomes very valuable and can become by itself a trading edge that you can run an entire strategy of. So that's the zoomed in view, how to trade it, how to interpret it. We had the zoomed out view for the aggregate, and that is CVD analysis. That is how to trade using CVD. That's the lesson finished. Let's move on to the next one.